Ladies, gentlemen, and dear members of the community, we are once again very grateful to have you here for your time and to have your support. And this presentation today is a culmination of months of hard work and research. And we are beyond excited to provide an in-depth look for the first time into what we have been doing and how we have been thinking about stuff. And today we want to achieve three things. First and foremost, we want to give you an intuitive understanding behind how the Premia system works. And number two, we want to explore some of the more interesting technical implications and nuances. And finally, number three, we want to provide an insight into our active areas of research. So we will start with a higher level view of the entire Premia architecture and go through the steps of a transaction from a buyer's perspective. We will then proceed with an intuitive exploration of our pricing model and considered some meaningful liquidity implications. Afterwards, we will continue with a more technical deep dive of the pricing model and then take a tangent towards some of the more mathy implications. And finally, we will then turn to the lesser talked about problem of pool accounting before proceeding with considerations behind vault design and other quality of life features. But first, we must consider the Premia pool architecture. The most granular notion within the Premia system is the notion of a pool. Now, every asset pair has two pools, a pool for put options and a pool for call options. So each pool has just a single asset in it. And in the case, let's say, of an Ether USDC pair, the calls pool would have just the underlying Ethereum in this case, and the puts pool would have the numeraire asset, USDC, in this example. And all options purchased from the pools are fully collateralized, and the underwriters take covered positions in both. Now, let's consider the transaction flow from the point of view of the option buyer. The option buyer first selects the option input parameters, which is the strike price, maturity, and notional. And they are basically able to select any values they want within some rational bound on the input space, meaning you won't be able to select 10 times the spot price as your strike price, but most people don't really want to do that anyway. And these parameters are then sent to the AMM, and the AMM returns a quote for the said option. When the buyer then accepts the quote and pays the premium, the liquidity is then reserved from the pool to ensure full collateralization of the position at all times. At expiry or exercise, the net difference between the strike and spot is calculated and settled in the asset of the pool, which implies that call options are settled in the underlying, while put options are cash settled. Optionality of settlement mechanisms will be added in the future as a quality of life update. But anyway, the key question is, once the parameters are sent to the AMM, what price should be charged for any given option? And in order to tackle this problem, we first have to assume that there exists some theoretical equilibrium pricing curve for all options that can be purchased from a given pool. And the thing about this theoretical curve is that it can change as a function of exogenous market circumstances and other conditions. But if the pool's pricing curve is below said equilibrium curve for any given input value, then all options are underpriced and LPs lose money in risk-adjusted terms. On the opposite side of the spectrum, if the pool's pricing curve is above said equilibrium pricing curve, options then are too expensive, there is a lack of demand, and LP capital becomes underutilized, as a result of which they lose time value of money and their capital basically sits idle. So surely there is some equilibrium pricing curve that can price all of these options efficiently. And So in trying to find this equilibrium pricing curve, we can start by thinking about what type of shape it could possibly have. And when thinking about the shape of this curve, a good starting point is to think about other pricing models for options, such as the Black-Scholes model. And we all know by now it's poorly applicable to the crypto market infrastructure due to substantial deviations from the base assumptions. However, there is no reason to assume that a deviation from these assumptions would cause inconsistent mispricings across the option input domain. So put simply, if we believe that the Black-Scholes model underprices a 30-day Ethereum call with a strike price of 2K by, let's say, 20%, then we have no reason to believe that it would underprice a 60-day Ethereum call option with a strike price of 2.2K by anything other than the same 20%, which is a critical insight and, to a degree, also an assumption. But in other words, we have no reason to believe that the forces driving the shape of the Black-Scholes function break down in the crypto market microstructure. And because of that, we can assume our theoretical market pricing curve to be the Black-Scholes function times some arbitrary constant c, which, again, we don't know. So the question then evolves into how can we possibly find the c? How can we go about finding it? And the answer is that we need to let the market tell us. And the way we can go about this is we initialize this pricing function with some C0 and look at the market signals to update this to new values of C. And the intuition behind that is that if we observe added capital to the pool, then that tells us that liquidity providers are happy to provide capital at said price level. And assuming rationality, this implies C being above or equal to the theoretical market clearing C, at least asymptotically. On the other hand, if we see capital withdrawals, either in the form of option purchases or removed LP positions, this signals that the pool C is less or equal to the market clearing C under the same rationality and asymptotic assumptions. So all we have to do, in a sense, is make the pool react to market signals and allow for market-driven convergence. Now, the C adjustment itself. To achieve a meaningful adjustment mechanism, we've designed a state transition mechanism that updates the pool's C value after every transaction. In the exponent function, the algorithm takes into account the relative size of each transaction in percentage terms. So as an example, if there is 100 Ether in an Ethereum call pool and a liquidity provider adds further 10 ETH, this would be roughly a 9% disruption, which would then be fed as an input into the exponent. And the same logic just inversely applies for removed liquidity. So now let's consider how all of this looks in practice. And suppose we have just created a new pool, an Ether calls pool. And we initialize the pool with some guess constant, C0, say equal to 5. Initially, we have to take into account that we have 0 assets in the pool. And because of that reason, no options can be purchased at this time. However, if an option buyer was to submit a request, they would receive a quote that is the Black-Scholes price times 5, which in other words is an insanely high price, and nobody in their right mind would buy it. But at the same time, we have to acknowledge that at any given pool price, the probability of a buyer purchasing an option is non-zero. And because of that, liquidity providers are incentivized to provide liquidity to a pool in case an irrational buyer happens to do a transaction. So we observe liquidity providers come into this pool, and with every added unit of liquidity, meaning every transaction that adds liquidity in net, the pool's C value is driven down until it reaches a price where buyers and sellers are happy to transact. We are currently working on a paper further detailing this mechanism, but the key takeaway is that under even highly volatile market circumstances filled with a bunch of irrational actors who are just basically throwing money in the system at random, this system converges to a clearing market where liquidity providers earn a market return and option buyers are able to get a fair market price. And another implication is the high level of liquidity utilization. But more information on this can be found in our Gitbook and will also appear shortly in our technical white paper. But now, to immediately consider the same problem from a more technical angle, Enzo, take the stage, please.
Thank you very much, Carlos. And now we will a bit talk in math, but just a bit. Like it's the formal introduction into Premia pricing model or C-value model. So as all we know, Black-Scholes ignores three fundamental degrees of freedom for the market. Supply-demand balance, Americanness of the option or the possibility for early execution, and volatility dynamics. So we need to find the way for unbiased options pricing that captures some of these factors. And the problem is there is no closed form solution to the model capturing all of these concerns. But what if instead we learn from the market itself, from the behavior of market traders and other actors, right? Let's take an approach for step-by-step or sequential learning for supply-demand dynamics for American options. Now, how C-value originates mathematically? Okay, first of all, let's observe that American option prices are always more or equal than European option prices. Yeah? Thus, we can incorporate some Americanness multiplier, such as the Premia price equals this multiplier, which ranges from 0 to infinity, from 1 to infinity, at times the Black-Scholes model, right? So it makes intuitive sense. So it can be either like Black-Scholes or just higher. Okay, now the second part is like we want to capture also supply-demand dynamics over American options pricing. And let X be the percentage change on supply-demand at the time t, right? The ST here is the pool state at time t, and ST minus 1 at the previous time, right? Now we got our nonlinear model, which is yet simple, but self-explanatory. But we also want to satisfy few requirements. The first one is obviously no trade means no change in the C-value, right? And the second one is the rate of change is proportionally inverse of the value of change. That means that when market reacts on liquidity provision, the model should render be lower, and when liquidity is withdrawn or locked, it just makes the C-value higher. Okay, now the solution for our requirements that we stated on the previous slide is the exponential decay function family, and we just can rewrite it in C-value terms. It's actually not the full representation, but for like all the juicy details, you can always refer to our white paper. And now we can say that the Premia price is basically the C-value at t times Black-Scholes model calculated at t. And now we got sequential unbiased American option pricing model that potentially could learn from market by like capturing instantaneous supply-demand balance change in the pool. But shall it learn? Let's find out. The convergence of the C-value is the key problem for my part of the presentation. So let's dive deep. We now obtain the model which is both stateful, which means our state depends on the previous state. It's non-linear and it's path dependent. On the one hand, such a multiplicative dynamic model is great due to its state responsiveness to market conditions. It immediately reacts to disruption in supply demand and so on. But this makes our question about convergence much harder. And we would like to take both approaches, top-down approach, analytical approach, and from bottom to the up simulation approach to demonstrate C-value convergence. Okay, the first one looks maybe a bit scary, but basically it says, okay, we potentially could model the C-value trajectory or evolution through the time with Brownian motions with some growth dampening factor. So we have here that the first term means like how the Brownian motion, the drift and the noise affects X, right? And the second one means that we want to discount by some factor that will help so to reallocate the impact on the C-value. And the important note here, it is not about financial reallocation or something like this, but it is the way how to not impose any penalty on the pool growth. Basically, in the multiplicative model, we say like, if there is the growth factor, it will just blow up with impossible to predict consequences. But we would like to ensure convergence. That is why we have this reallocation factor. And actually, cleverly taken, this growth dampening factor guarantees the convergence. But now let's take another approach from the bottom to the top. As Carly said, we assume there is unobservable market clearance price. Like it's just some unobservable price times the Black-Scholes, right? Some unobservable coefficient, sorry. And now we assume that deposits are incentivized at some point of time when the price of option in the pool is larger than the market price times Black-Scholes. Or put in another, like this C-value is higher than market clearance unobservable variable. And now, and of course, purchasers are incentivized otherwise. We now model all of this as the normally distributed actions around the market clearance with some uniformly distributed noise, and run the simulation for different pools many times. Let's just take a look at one of these. So we took the data from CoinGecko for Bitcoin 1 year, and we assume the market clearance coefficient is 2. And now we can observe the C-value evolution. And the highlight here is like, yeah, C-value does converge to market clearance coefficients. And it basically converges to any market clearance with even exotic numbers like 0 or like hundreds and thousands. So C-value is guaranteed to converge. But what happens with the pool capital? And another thing shown by simulation is like initial size of the pool does not matter. And the capitalization of the pool naturally tends to grow. We have observed it many times in many simulations. And the last question is about pool utilization. Because we put a high degree of probability to the simulation, the pool utilization still can jump, run, and so on, up and down. But at the end, we see it stabilizes over time, and with the capital growth, the standard deviation of volatility of pool utilization goes down. Now the last part is how we calculate volatility. And our current approach is calculating volatility or variance, right, as some historical or realized volatility factor, which is also governed by time discount factor. This means that the high volatility proxy just weighs the contribution of new Oracle spot pricing data based on how much time passed between our previous high volatility query and current query, which means like if no time passed, we just discard the new information. If infinite amount of time have passed, well, just some substantial, we probably will just forget about the previous volatility and we'll just take a current one. Oh yeah, what is the immediate disadvantage here? Immediate disadvantage is, of course, that the resulting volatility we get from these equations is scalar. And of course, as we stated in the beginning, it is not the way for like multi-dimensional dynamics capturing. So we would like to account for non-stationary applied volatility. And in our plans, we have like key components to incorporate. First, the volatility surface induced by Premia traders, which is also known like volatility smile, or conditional dependence between strike price, maturity, and volatility curvature. Second one is volatility jumps that are very, very common guests in the crypto market. So we should think how to incorporate them. So model should react into rapid changes in spot prices and the volatility in a coherent way. So basically the pool stability will not be broken. And the last part here is volatility research for forecasting and so on, just to be able to do like data analytics on the Oracle data and other sources, our own data and so on. This is it for my part. Thank you very much. And I'm passing my microphone.
Thanks, Enzo. So the main problem with pool accounting is how do you fairly account for liquidity provider returns and withdrawals on active versus inactive capital? And so we have some examples to exhibit this, and it might seem self-explanatory at first, but I promise you the problem is far from that. So when an option is purchased and there are multiple liquidity providers in the pool, who should underwrite it? Who should get the premiums? What about when capital is deposited to the pool? What proportion of that pool's past and future profit and loss should that liquidity provider be entitled to? How do you manage withdrawals in a highly utilized options pool? Let's say the pool has 90% of its capital locked in options and a large liquidity provider wants to withdraw all of their capital from the pool. How do you manage this in a way that's fair to all liquidity providers? And how do you prevent information arbitrage from ruining liquidity provider returns? Let's say it's very clear that a bunch of options are about to be exercised in profit. How do you prevent all of the liquidity providers from removing their capital at this moment in time? Or how do you prevent all of the liquidity providers from joining at a time when a bunch of options are about to expire worthless? The solution that we've come up with is a fair sequencing system for liquidity provider intervals. So this is a system that allows all of the free capital in the pool to be sequenced in terms of intervals. This means every time a liquidity provider deposits their capital, it will be sequenced into an interval defined by three parameters: the liquidity provider's address, the interval number, and the size of the interval. So when a buy order comes in to the AMM, the buy order will scan as many liquidity intervals are needed as to cover the position. So in this example, the option of 6 ETH covers 2 intervals. So the first liquidity provider will underwrite 5 ETH worth, and the second liquidity provider will underwrite the last 1 ETH. So this happens in a first in, first out system. This allows liquidity providers to capitalize anytime the C level is too high. In our example, the free liquidity provider interval would be incremented by 1, and the next time an option is purchased, the second liquidity provider in the interval would underwrite the first part of the option. Whenever an option is purchased, its expiration is immediately calculated and placed on a list in the contract ordered by its expiration time. When an option expires or is exercised, if that liquidity provider who underwrote that option has an existing free capital interval in the pool, then the newly freed capital will be just added to that interval and the amount will be increased. Otherwise, if you don't have an existing free capital interval, a new one will be created so long as the amount freed exceeds the minimum interval requirement. The reason that we impose this requirement is to avoid unbounded capital fragmentation. So let's think, an option buyer wants to buy 1,000 link call, and the first 1,000 liquidity provider intervals are for 1 link each. This option buyer would have to pay the gas to loop through 1,000 different intervals, which is very inefficient. So this is the situation that we are aiming to prevent. The next situation that you need to take account for when looking at pool accounting is how are funds withdrawn from the pool. So at any given time, a liquidity provider has 3 sections of capital. They've got their free capital in the pool, including the intermediate capital. They've got the fees that they've accumulated from premiums, and they've got their active positions, which are locked in options they've underwritten. The free capital and accumulated fees that are not locked in positions can be immediately withdrawn by any liquidity provider at any moment in time. However, their active options positions must be exercised or expired before the liquidity provider can withdraw that capital. Otherwise, the liquidity provider can do what's called reassign those options to another liquidity provider in the pool by paying the premium to allow another liquidity provider to take on the risk of underwriting that option. Once options are reassigned, the original liquidity provider can withdraw all of their capital from the pool. An alternative to this is called gradual withdrawal, where a liquidity provider says, I want all of my capital to be released as soon as it's unwound from its current options positions. And if this is selected, all of the capital will be blocked from entering new options as soon as it's exercised or expired. This finalizes pool accounting. And so I'd like to move into MetaVault architecture next. And this is our way of aggregating pool strategies and embedding various liquidity provider strategies into our pool architecture in a way that they can be implemented automatically. So this is made possible by using our Premia pools as the base layer money Lego. So what this means is we can build future strategies on top of these existing pools, and the vaults will provide their capital to specific pools based on their strategy. So some of these potential future strategies include options trading strategies like credit spreads, straddles, and other short volatility strategies, delta hedging strategies, allowing liquidity providers to hedge their possible loss from underwriting options, and others such as deploying capital on momentum. When the C value goes too high, a vault could deposit their capital into a pool. If the C value goes too low, they could withdraw their capital, allowing them to capitalize on high premiums. And there's multiple other strategies such as pricing arbitrage and optimizing for Premia token farming that we're also actively looking into. The last piece of tech that I'd like to explain is keepers. And these are the ways that we're automating some of our on-chain actions. So one example is whenever an option expires in the pool, that capital needs to be unlocked by a user in order for it to be moved back to the free capital pool. There are a couple ways we can have users do this on purchase or on deposit or withdrawal. But one way we're actively looking into doing this is through keepers, such that we have a chain link or other keeper watching the chain. And anytime that the keeper is available to run the function, it says it runs it, which would automatically unlock any expired options in the pool. And the keeper would be slightly rewarded for running that function. Another way we're looking into using keepers is to automate take profits for users. So let's say a user has purchased an option and an ETH call option, and they want to exercise it if the price of ETH ever exceeds $3,000. Well, they could do this in our user interface, and the keeper would then watch the price of ETH. And if that option ever hits its take profit, it would automatically exercise it for the user, and the user wouldn't have to do this themselves. So there are multiple ways we were looking to use these automated keepers to make the user experience nicer and to solve some problems within pool accounting. And we look forward to showing these to you in the near future. That wraps up my research. And I thank you guys for joining us today. And I look forward to talking to you guys in the chat for the Ask Me Anything.